content presented today is not directed to any investors or potential investors and does not constitute an offer to sell or a solicitation of an offer to buy any securities. So that's that. Now we got that out of the way. Let's let the show begin. So without further ado, I'd like to go ahead and introduce the panel here. So maybe we can start with you, Tyler. Would you like to quickly introduce yourself to the community here?
Yeah, for sure. Thanks for having me. Big fan of what you all are building. I am a Chicago boy, studied financial economics and computer science, data science. And luckily during that experience, I was able to go into venture capital pretty early. My freshman year, I worked at a bank like a lot of folks who go into finance. I hated it. It was like Morgan Stanley takes 10 kids in the country and throws them off the deep end. From there, I was like, no, this isn't it for me. And I decided to go work in tech, and I found venture capital to be a good blend. So when Formation 8 was shifting to APC, they needed an analyst, and my school happened to have a program where I could work full time while my professors flew me on the weekend. So I joined APC as an analyst, and then before I finished undergrad, I worked at 5 different funds. So Felicis Ventures, WonderCo, Unshackled, and then I also helped co-found Contrary. From there, I've been watching a show called Billions, and I wanted to work for Bobby Axelrod in real life. So I pinged their team, was like, hey, I heard you're launching a venture strategy and growth equity strategy, and you should have me be one of the founding members. And it worked out. So I went to Point72 to help launch that strategy, invested across the stack in fintech, infrastructure, enterprise infrastructure, some deep tech, and then some random consumer tech like Mirror and Peloton and Spotify. From there, I kind of became a little bit more entrepreneurial. Like I left Point72 for like 6 months to join a firm under the old CEO of Oracle and the founder of Juniper Networks, but then I was like, nah. So I decided to, like probably many of the folks in this crowd who were making their first time funds, get some operating experience. So I co-founded a startup studio with a serial unicorn founder. He founded Virgin Mobile and sold some companies to SoftBank, and then made WeWork's biggest competitor. So we launched 10 companies, 8 failed, 2 were okay. Tiger Global backed one alongside B Capital. North Zone backed another one alongside some strategics. And I launched a content business focused on uplifting venture capitalists called Confluence VC alongside a great co-founder. And today, after kind of stepping away from my companies after I placed CEOs in them, I partnered with the person who was running the Estee Lauder family office for 6 or 7 years. And we created a full stack investment platform that has, at least for the first iteration or two, the family as a sole capital partner in an evergreen structure. So right now I invest in fund of funds, which is why I'm so interested in VC Labs and Decile. And I also invest in funds in addition to continuing my full stack investing from pre-seed to growth. And my goal is to be the liaison across all of them. If you're a direct company or startup, I want to introduce you to the best early stage to growth stage managers there are in your given geography or strategy or sector. If you're a manager, I want to introduce you to the best LPs, whether they be a decile if you're getting started, or, you know, a Sindana or a Level, or maybe you want to meet like, I don't know, the Schmidt family or the Schustermans. I couldn't tell you, but whoever you are, I just want to be helpful because I've had a lot of people help me, and I don't think that this market should be so disconnected.
Agree 100%. Thank you so much for joining us, Tyler. Stephanie, would you like to introduce yourself as well?
Yeah, absolutely. And thank you, Mike. It's a pleasure to be here. As you know, I've been a big fan since day one of what VC Lab is building, and to kind of echo Tyler as well, want to be collaborative, want to be helpful. I spend a crazy amount of time envisioning what does Venture 2.0 look like. And so I love being amongst a crowd that kind of thinks the same way. And I know VC Lab is at the forefront of that. Quick autobiography. Career 1.0 for me was in neuroscience research. So I was a scientist and neuroscience professor at Vanderbilt University for several years before I went rogue. And that was in order to try to make more impact. And it wasn't a direct line, but pretty soon, not soon enough, but pretty soon, I had the insight that I had something to offer product development teams. So I came out to Silicon Valley. It's a bit of a gamble. But here we go. If I'm going to make impact, it's here. So the trajectory has been neuroscientist, brain geek, to startup whisperer, to venture capitalist. I've been in VC since, I guess, early 2018. Co-founded Practical Venture Capital, which is a secondary firm. That means we don't invest directly into companies. We buy out GP and LP positions. And yeah, just looking to see in any asset class, there are pluses and minuses, right? And VC is wonderful. And to quote Adeo, he said something that stopped me in my tracks one day. VC is the R&D arm of humanity. And so when we're doing it well, the R&D lab is cranking. But there are challenges around transparency, diversity, illiquidity. So I'd be happy to talk about any of these issues today and beyond. And of course, we've got to focus on fundraising. So just happy to hear any questions and learn what interests you. Thanks for having me, Mike. This
Amazing,
really
amazing.
fun.
And last but not least, Steve.
Good morning, all. And yeah, Steve Bennet here. Full disclosure, I am a early, I think, pre-seed investor in VC Lab and also an LP in Decile, the fund to funds. So obviously a big fan, and I also played the role of interim part-time CFO for a couple months while while VC Lab was early in scaling. So yeah, I love everything that they're doing, and I've been a mentor in a bunch of the cohorts. So for me, for the last 3 decades now, I've been splitting my time between teaching entrepreneurship at university, currently on the faculty at San Jose State, investing in startups and funds. I think I've made probably 150 direct investments, and I've invested in as an LP in over 25 funds now. And then also being a part-time CFO board member for a number of startups. So really kind of seeing the entire ecosystem. And I haven't met, I met Tyler before, I haven't met Stephanie, but I see that her partner, Dave McClure, is a former student of mine. So I was an investor in his first 2 funds at 500 startups, and then sold an LP interest to Practical. So yeah, it's it's a small world here, and yeah, very interested in kind of taking your questions and kind of talking about the current climate and raising a first fund.
Yeah, it's an incredible panel here, everyone. And again, we're doing this for you, right? So if you have questions as we kind of start the questions here with the panel, add them into the Q&A. It's at the bottom of your screen, and you can upvote those questions. So we're going to go ahead and try to cover the top questions that are coming into the Q&A, because again, we're doing this for you. Maybe we can just start at the very top here. Maybe Steve, we can start with you on this one. I know you've got a lot of experience as a limited partner in lots of different funds and things like that. And I just kind of wanted to maybe go back to like the beginning a little bit and just try to kind of understand like what inspired you to become an LP in the first place.
Yeah, I don't know if there was an inspiration. It wasn't anything I thought about. Like everything else in the Valley, it's and certainly with my career, it's a bit serendipitous. So in the late 90s, I had met up with Ron Conway, very active angel investor, still is, and he had a fund, Angel Investors LP, and they were, going to invest in 200 internet companies, and this was before the, during the boom and early of the boom and before the dot-com bust. So it was, I saw this as a great opportunity to really kind of get into that ecosystem and invest in an index fund of internet companies. So it was access, it was network. They put on a lot of events. It was a who's who that was involved. And kind of given the timing, most of the companies blew up, but this is an example of a power law. One of them was Google. So I'm still holding Google stock at a I think a 20-cent basis. So you can have one company return an entire fund or multiple of funds. Actually, if you sold the stock when it was distributed, the fund probably wouldn't have been a 1x, but then if you held it for a long time, then it's a huge return. So that was the first fund I got involved in, and I kind of see it as a one, kind of the network and getting direct access. So one of the things I like is the ability to invest in portfolio companies of the funds. They often offer LPs the opportunity to invest directly, and then it's kind of a buy versus build decision. So do I want to, and I do want to invest in a portfolio of startups, but also it's a way to get access to more. And as I move later in my career, I do like investing more into the venture class versus the time it takes to invest, create a same portfolio directly.
Tyler, you've had like this incredible career, both on both sides of the table, so to speak. Like, maybe how did you kind of end up getting to this place where we wanting to be an LP, and what were some of your inspirations for this?
Well, when I was much younger in my career, like a piece of advice that always stuck to me was build on the shoulders of giants, which translates to like use gravity to your benefit. So when my partner started to ask me as I was building my companies to invest on behalf of the Waters, and maybe even at 0.72 when we got a few decks from different funds, I got a taste of what it was like to be an LP. And I also remember what it was like being a junior investor and like having the gatekeepers of the firm behave so differently from founders to us as employees to their LPs. And I really started to become curious about, who are these mysterious LPs? So as I was building out my own platform, I thought to myself, one, venture itself is far too opaque. Two, I want to always come in from a position of power, or at least, oh no, we lost. Well, anyway, yeah, I always want to come in from a position of power, or at least a position in which I can be connected to someone who's valuable to the most valuable person in the room. And it became very obvious to me that the only way for me personally to very quickly get to the top of venture, to be able to get access to what I wanted and insights and connectivity to what I wanted, was to become an LP. I believe wholeheartedly that the data has shown that early stage sector specific fund of funds outperform. So great, let's assume that I can make money in it. But if I want to go beyond that and have those incredible outsized returns, I felt that I needed to have access to the best deals. And I, for myself, have just used LP platform as a means to do that. So I'm seeing the best fund of funds. It's not that hard for them to know who the best funds are. If you see the turnout that VC Labs right now has, it's pretty obvious, right? And then the best managers, they know who the best folks are within their ecosystems. They become key nodes and helpful figures and experts. So I would say for me, the inspiration is wanting to truly understand what's happening. One, from a trend perspective, two, from a where capital is flowing perspective, and three, from a proprietary insights and connectivity perspective. And I don't think that anyone has their hand on the ball as much as the key LPs in this ecosystem.
Stephanie, I'd love to kind of throw this question over to you. And I know, practical goes kind of almost at the other side of it, right? Where you're looking at like secondaries and things like that. But tell me kind of what was your inspiration for starting this and kind of being in this space?
Yeah. Well, admittedly, I have limited experience myself as a limited partner. I currently don't meet the qualified purchaser definition. So I would say I'm in a bit of a hybrid stance compared to where I would like to be. And what that means is, I can take LP positions in my own fund. So we're just starting fund 3. Fund 1 was a series of SPVs. So it was quite helpful. I guess this is just reinforcing, this is non-news. This is something that everyone knows, but you really have to demonstrate that alignment of motivation and skin in the game with your LPs. And so early on, PVC was able to say all 3 partners are putting in on, every vehicle that we do. I wish there was another comma to the capital commitments that I made, but that's where I was. And then the hybrid aspect is, it's almost like when I landed out here several years ago, a lot of the work that I did was pro bono, was sweat equity. I mean, I was an oddball insofar as I was a neuroscientist secret weapon as part of a product development team. And so it sometimes was the case that I would have a champion that would bring me in, and then I would have to kind of demonstrate what I could do to for the rest of the team. And that pattern is playing out again in a way where on the one hand, I'm very fortunate and very grateful to have a lot of requests to sit in as an advisor for companies. I wouldn't be able to do even half of the invitations that I get, but I can be selective about them. So I'm taking cap table positions from sweat equity. So that's my hybrid LP model, at least for the next probably 2 years. But in terms of getting into venture itself, the work that I did to like 2015 to 2018 was most beneficial with companies, the earlier the better. This was like putting in behavior change principles, design heuristics, really fundamental things into the DNA of the product. And often, that meant that the company didn't have funding. So it was high risk. And I realized personally, like, okay, for me to really to survive and then thrive, I've got to figure out this venture capital game. So in leaning towards that, Steve, thank you. You did the introduction to Dave. If anyone is around Silicon Valley long enough, you're going to run across this character, Dave McClure. And I was lucky to do so several years ago. And, it's just been, it's just been amazing since, to kind of come up with this contrarian investment thesis. It's very well timed.
Well, maybe we can talk about that. I'd love to kind of get you, maybe we can start with you on this one, Stephanie, but I'd really like to just throw this at the panel, kind of like,
Sure.
How are you seeing the current market conditions, like the fluctuations in the market, kind of affect venture capital, and maybe we can start with you. How are you all seeing this at Practical? And then maybe we can go to Tyler and Steve with this question.
Yeah, I would say our fundraising efforts really are tapping into kind of like a bimodal distribution. It's not a normal curve in terms of time that it takes to convert a new LP. We're seeing a lot of LP prospects slow down, grind to a halt, have liquidity issues, or even are struggling to meet their existing capital calls. So they want to hear what's out there, but it's hard to get them on board. And then at the other side of the distribution, so it's like no one's average. People are super fast or super slow. Some of those fast cases have been ridiculously fast. As of a year ago, it seemed like a lot of folks that were trying to reallocate, folks that had made a bit of wealth in crypto and wanted to diversify from there. And it was laughable at times, like being able to be at the point of sending out subscription documents when it was just so quick, sometimes not even meeting the LP. So, another thing this reinforces is like the current climate feels like don't go fishing into new ponds. The word of mouth that you get from existing LPs, those introductions can be gold. And indeed, I saw the quickest that I've seen is it was like an 8-minute back and forth over email. And then the guy was signing his LPA, and it was a $5 million commitment. So I've seen super fast and super slow start to develop in the last between year and a half.
How about you, Tyler? Like, how do you see this current market affecting venture capital in the short, medium term? What are your thoughts?
Yeah, I'm seeing a few things. I do think that there's a rush to quality, which is inherently a good thing for everyone, unless you believe in like the law of big numbers and the more capital, the more opportunities. Like, actually, I'm gonna recant that statement. But I actually what I've been seeing is people actually do due diligence again. I think that what's beautiful, yeah, what's beautiful is that a lot of people are starting to see that rushing into very poorly structured deals doesn't work long term. Like, paper gains don't equate to cash gains. And that reality has a lot of secondary and tertiary effects. So what LPs, at least in my opinion, the smarter ones will be doing going forward is, outside of the obvious, like making sure that they're not investing into a fund that's like more than 20% deployed, are looking at hit rates. They're not just looking for that one winner anymore. It's like, well, how many of these things won? Of the companies that you did win in, what are the fundamentals of that underlying company? Do you actually have discretion, or did you take advantage of this, call it 4 or 5x plus increasing unicorns being created over the last 4 years? Separately, I think that people are now looking for new areas of innovation and opportunity. I think that multiples matter again, which I'm so happy to have been like raised in a hedge fund environment, because I didn't really ever stray away from that. But in certain areas, multiples are still ridiculous. Like if you're looking in AI or fintech, where I was raised. So people are now saying, well, look, the laws of venture have never changed. It's a reasonable volume per your level of risk. You're trying to get in at the lowest price possible, not the highest price possible. And you want to have a nice underlying ownership across that diversified portfolio. And what that means for serious funds raising is that you have to provide a product that gives that. Like for me, if I'm looking at you, it's like, what is your portfolio construction? What is your ability to win deals? What is your level of discretion? And how do you actually discipline and time your exit horizon to support your portfolio through whatever cycles may come? And then if I take a step back from there, I'm saying, well, how does this actually help my portfolio construction? I need X amount of GPs in this region, X amount of GPs in this sector. And that really does put you against a wider array of competition, because you can think about it like a sports team. I have a roster that I need to fill. So now that a lot of the money's becoming more and more disciplined, this slew of like call it 10,000 funds that have come out over the last decade, like they're going to truly have to compete, because a lot of the money that was backing them was family money or new wealth money that isn't even at scale to be a real family office, is going to dry up, because they've put their money into places that won't be liquid for, call it 7 to sometimes 20 years. And opportunities for new wealth creation aren't just popping up. Like maybe secondary markets will save them, right? But it's a zero-sum game. The money got to come from somewhere, and it has to get recycled. And the people who have coins left on the table, they got to put them in the right places.
Steve, you've been through lots of ups and downs, right? And you've seen multiple kind of ups and downs in the market. How do you see this current market affecting venture capital?
Yeah, I mean, I was just thinking as that I was listening to Tyler and Stephanie. So yeah, I've been investing in funds for 25 years now. So we've had a few cycles. There was a period from at least a 10-year period from 2001, 2 to 11, 12, where aggregate returns on venture capital were zero. So you were much better, putting your money in bonds, index funds, anywhere else but this venture capital class, unless you could get access to the top decile or definitely at least quartile. So yeah, kind of where I see it today from the LP perspective, you're having fewer exits, which means fewer distributions. So over the last several years, as distributions were coming fast and furious, it was like a poker game and you're winning and you got all these chips, and I'm gonna place some of these winnings here and there and maybe take a little bit off the table. Now, there's not a lot of activity at the table. So, it's a bit harder. Then it becomes for institutional LPs, it becomes an asset allocation game. So I think that's going to make it more challenging for managers, and probably particularly larger funds where, the fund cycle had compressed so much, where you were raising a fund every 12 to 18 months instead of 3-4+ years. Now you're going to go back to raising over a much longer period, have the fund cycle run longer. And we haven't seen, back in the early 2000s, we saw a lot of funds give back LP commitments. I haven't really seen it. I think I've seen one or two, but I don't think we're gonna see that this time around. But definitely things are gonna slow. On the flip side, I think as Tyler mentioned, investing at more attractive valuations, will has to positively impact returns. It's just going to take longer to get those returns.
And this is a question for anyone on the panel. Like, we don't have to have everybody necessarily answer it unless you want to, of course. But I want to kind of dovetail on what you just said, Steve. So there are obviously some headwinds, but there's also a lot of opportunity, just given that the multiples are lower. Lots of like resilient founders building things. For anybody here on the panel, is there like any specific opportunities within venture that you're like very excited about, specifically for 2023? Any themes, any theses, any kind of anything? Tyler?
I am not particularly excited about any vertical, but I am excited about a paradigm shift, which is the cost that it takes for someone to build a real business has dramatically decreased. Like, generative AI just became a thing. But like, if you were to go back like 2 years ago, that was also the reality, right? Like, whether it be gig economy, offshore working, no code repositories, or whatever it may be, or like a myriad of different distribution marketplaces, platforms, partners, and then an infinite stream of tools that help you measure your customer success, bandwidth, push out content, and all these other things. Like, a good business should be able to get to scale much cheaper, which matches the thesis of investing less at lower valuations. So to me, what I'm very interested in, like across the board, is founders who are incredibly aware. Someone just said not in healthcare. I can make arguments against that, but whatever. but generally, like, my thesis is generally any founder who's disciplined in their spend and are showing me that there are new ways that they can scale are really, really attractive. That said, the flip side of that is competition can be spurred up much faster as well. So it'll be a race who can have some type of proprietary platform or partnership of distribution, or, you know, IP becomes a real thing again. And then I don't want to talk about healthcare right now, but I would, in short, I would say that the same driving factors that enable any business to cut costs apply to healthcare entrepreneurs as well. And there are some accelerants in approval processes that are becoming more real. So that's my opinion, and I'm not going to go into detail because you're probably smarter than me, and I want to learn from you.
Anybody else on the panel have thoughts on this
Yeah.
topic of like opportunities? Oh, Steve.
Oh, I just say
Stephanie, you're unmuted as well, so you can go.
yeah, I'm more of a generalist. So I have areas that I'm interested in, but certainly you got to look at, you know, what problems need to be fixed. So, you know, I think it may finally be time for some big returns in climate tech. Certainly there's a lot of people working on it. So that's, you know, that's something. But again, I would focus on, you know, kind of where you have expertise versus where you think people might be excited today or, you know, a year from now. Because, yeah, I mean, AI was brought up, but we've been talking about AI, ML for, you know, for years and decades. So certainly there are a lot of interest. And if you're just looking to be able to, you know, raise some capital or raise a fund on that, then maybe you can, but you got to think longer term and how you're going to kind of beat out everybody else who's doing that. So I tend to want to learn from managers and entrepreneurs and kind of make my bets accordingly rather than necessarily trying to find the hot sector.
Stephanie?
Excellent. Yeah, chiming in here to also say, yeah, generalists, not super hot on any one vertical, but what I am really pumped to see these days is a type of system-wide collaboration between venture investors, government, NGOs, and other stakeholders inside of, you know, inside of a national playground, let's call it, inside of a, like really looking, how do we amp up and redefine this whole ecosystem? So not saying that these are the two hot spots, the paradigm shifts that are happening across private investing and government. This is where it's happening the most, but this has just been my bias sampling thus far. I've been able to find a door in to stakeholders in Japan. You know, the new-ish prime minister is calling for exponential growth in their startup system. And I'm sure it hurts Japanese pride to say, and our nation is grossly behind in terms of where we should be in venture funding and innovation. So, you know, we're looking at a trip and a long-term project on the ground in Japan. And then secondly, in Scotland as well. So I'm representing myself more so than PVC at this point. About 2 weeks ago, it was Tartan Week in New York City, and got to meet with a bunch of Scottish enterprise, Scottish development folks. And, you know, it's just incredible. Like they're listening, they want venture expertise. And as far as Scotland goes, I would like to share something that was pretty shocking, actually, in contrast to the US angel to seed to, you know, Series A types of experiences that we usually see. Talked with a lot of Scottish startups and realized that founders there view angels mostly as a negative. Like the incentives are so malaligned. So how would I summarize this? Ecosystem redesign is happening. And leaders in venture capital are being brought forth, you know, like solicited by government. Okay, help us redesign this whole ecosystem.
Can't agree more. Africa is another good example of, a place that is booming just because of some of these things around more or less like ecosystem redesign
Yeah.
across the whole stack. Latin America is another area
Yeah.
as well, where we're seeing a tremendous amount of innovation across the board, both from the financing to all the support systems and everything like that. I'd like to shift into another topic. So, we have a lot of new and emerging managers, certainly on this webinar. And I want to kind of breach a topic, around kind of like diligence of GPs from the LP level, and like some, red flags that you may see, some things that get you excited. Steve, I know obviously you have some thoughts on this as well, because you generally give a talk and during the accelerator about some of these things, but I'd love to just put this out to the panel. What are some like red flags that you generally see from GPs that maybe some folks can start thinking about improving and potentially avoiding, and what are some things that make you kind of excited in your diligence process? Steve, maybe we can start with you.
Okay, I can start here. So, one thing is, and it's a little bit different raising a fund than, and first I'll take a step back. So anecdotally, I've had great returns on funds 1 and 2. And I was never quite able to figure out exactly why that was. Is it because the managers are hungrier? Is it because it's a smaller fund? Often, if you're successful, you get tempted to raise other funds, or and never quite really figured it out. But Mike's got some good data, so I think there's some Cambridge data out there that actually shows that the early funds do outperform. So that's good to see, and I think that's good for all of you that are raising first funds. I think the thing for me, this is a relationship. So same thing as investing in a company and entrepreneurs, but that can be a shorter relationship than investing in managers, which can be a very long-term, multiple decade relationship. So it's not I certainly appreciate Stephanie's story of the 8-minute LP close, but I've never done that, and I think that's
It was an anomaly.
That's certainly an outlier. I'm looking at kind of many months or longer, and oftentimes it's people that I've had relationships with over many years. So with a fund, you're going to have multiple closes. It's going to be hard to get people in for the first close. So often that's kind of based on the relationship. For example, with with Dave McClure, he was a student, so I know him for a long time. So with 500, I wanted to come in early and support, and I've done that with others. But it is a sales process. But if you try and put, I think Mike asked for red flags. I got one from a new fund that I got an email saying, okay, we're doing our first close. We have 1 spot left, and I'm not I'm not buying a used car or something. So if 3 LPs came in at the last minute and said we all want to invest, of course you're going to let them invest. So there's never like 1 spot left. So it is a sales process, but kind of remember who you're selling to. People are very experienced in buying, so it's definitely a relationship sale. So hard sell tactics probably won't work. That's one piece of advice.
I agree. Any other thoughts from your perspective, Tyler, on kind of like some red flags and maybe some things that get you excited?
Yeah, I would say to Steve's point, LPs have more information than managers. The average manager has to be talking to at least 100 plus LPs to get their fund closed. And the LP world is considerably smaller than the venture world. So imagine you're like a biotech like GP and a founder who's talked to over 100 biotech investors, like tells you something that is not true. So that's one, like just don't shoot yourself. But the thing that impresses me and pushes me away the most is thoroughness and generosity in information shared. Now, I don't mean like you telling me like if you have an algorithm, like how you built it, which by the way, some people will. I mean more so having a very, very, very robust data room. I want to understand your thesis, how you've mapped it out, the subsectors within that thesis that you're interested in. I want to understand in very, very thorough detail what your investment process is, what your committee looks like, what your post-investment process looks like, how your founder support mechanism looks like, and how do you actually see yourself competing to win deals long-term. I want to understand your economics between you and your partners, how that's aligned long-term, how you develop your team. All of these things, to me, are one, a signal for quality because thoroughness shows depth of decision-making. And then two, what I'm also measuring is your helpfulness and willingness to communicate with me as a partner and with your portfolio as an investor. If it's pulling teeth to get something from you, that'll be the case for the rest of our 10+ year relationship. If you are not willing to go out of your way to satisfy me as a customer, then you're not willing to go out of your way to satisfy your portfolio as a customer. Because at the end of the day, you're selling capital to founders and you're selling returns to me. And to me, not having these things well done out is like you just being a bad service or product provider.
There's a follow-up question here, from Javier in the Q&A. He's asking kind of, what are your thoughts or how's the interest of LPs, at least from your perspective, in like emerging markets in 2023, and are there specific emerging markets that seem to be more interesting than others? Thoughts? Anybody in the panel on that?
I don't have a lot, but I mean, certainly globally, I think there definitely is more interest. I was part of a fund that I didn't continue with called True Global Ventures that, we had, kind of affiliated partners around the world and based in Singapore. And one of the reasons that I got involved with it was I really wanted to see what was going on outside of this Silicon Valley bubble. So, I did speak at an event in Hong Kong and met a bunch of people over there. So, I definitely had the interest, but I it does take some effort. So I haven't invested in a pure kind of market play, somewhere else. I've invested in funds that have some activity, but I'm not an expert and I don't have a lot there, but my sense is that yes, there is interest in opportunity.
Stephanie?
I would second that and layer in how we were talking earlier about this relationship building is so important, and depending on what region of the world you're talking about, as a new fund manager, you've really got to put in the time to get access to companies or funds, or to be able to build the trust and the relationships with LPs there. It's not just fly in, collect checks, fly out. I mean, it's a long-term commitment, especially in certain areas. The GCC comes to mind, top of mind.
Yeah, and you want to be kind of the go-to resource for entrepreneurs in that area too. So if you can, kind of do that, I think you're going to see the best deals.
Exactly, and you really have to demonstrate that over time. You're not flying in and flying out.
Yeah. I am pretty big right now in investing in global. Part of the reason I'm so interested in, again, VC Labs is because of their exposure to global emerging managers. I think that business is like super simple. They're behemoths, there's innovation. Innovation can like expand margin or create new markets in an existing geography. But like eventually that gets tapped out, and then you have to go to other places to sell that same product, like international expansion. And those places also have their own innovation and sets of problems. So to me, any country that has a big set of problems or some play in which we can like use arbitrage on the knowledge and infrastructure built here, which is easier than ever with APIs or whatever we want to call the technology or knowledge transfer capabilities, is really, really interesting. So like when I was at Point 72, we tackled Southeast Asia and LATAM after we tackled the US, from neobanks to financial infrastructure. And the same thing will happen across the entire enterprise and consumer stack. So if I'm a manager trying to pitch to LPs, I'm really just saying, in my geography, what is the actual GDP here? What are the problems? What has been solved? What hasn't been solved? And then making that my thesis and making it very clear that this is an undercapitalized space, which means that I'll get better prices with less competition. And if any investor doesn't see that, I don't think that they're paying attention enough. And if they're not investing, it's probably just because it's out of scope for them. Like, I personally want into any sizable market that has a very clear problem to be solved.
Yeah, I can't agree more. And I would love to just dive in on that just slightly a bit more, because there are several questions in this, and I'm kind of paraphrasing a lot of the question is, I'm in this emerging market, LPs are a little nervous because of X, Y, Z kind of conditions. Sometimes it's political, sometimes it's just like the market in general. Sometimes it's other things, right? Yet, like as you so eloquently said, Tyler, there's just like an enormous amount of alpha, right, available in those regions. Any kind of like just high level advice on kind of how to communicate to LPs, how to kind of maybe put their any sort of worries to rest, any sort of thoughts? And I see several questions kind of around that same topic from the panel. Any thoughts there? Any advice for everyone here?
I guess since I'm like actively looking, I'll tell you what I want to see.
Okay.
It's not obvious to me. Like, there's certain markets I'm like, obviously Nigeria is great, right? Like, I'm also partially Nigerian, so whatever. But like, I think it's really simple, humanizing it and making a real business case. Look, these people are underserved from a financial perspective. They don't have access to this, and this. The population is this big. We believe that we can make this much money per person. The infrastructure exists, and we see these 15 places we're going to play. We've already identified 2 targets in each of these areas, and we've invested in 4 of them, or not 4 of them, but like half of them, and maybe the target's like 10. But anyways, the math adds up. And if you can present something that way, you're taking me on a story, because an investor has a structure that they think, right? Like, if you all write investment memos, you should be thinking that an LP is writing an investment memo. What is the TAM for this problem? How can it be executed? And what proof or comps do I have that validate it? If you can paint that picture and you hit enough funds, someone will pick it up, because if you can speak their language, all they want is to go back to their investment committee and be like, I found this obvious play.
And just again, there's a question here from Emil in the Q&A that kind of dovetails on that. And really it's around, I think, a lot of stuff that everyone seems to be talking about here is around kind of almost the developing trust through the process, I guess, building trust through the process. And, there's a question here from Emil, is like pointers, right, to kind of really establish that trust. I mean, Tyler, you mentioned really great and detailed data room. You talked about the memos. Steve, you mentioned some things around, obviously, like just not making some of these mistakes and things like that, like, not being a car salesman. But any other thoughts? Is there like a cadence to like the communication that you like to have from prospective managers, like with newsletters, with like follow-ups and things like that? Is there anything else there? Is there like something around reporting? Like what are some other things that people can do with regards to establishing trust throughout this entire process?
Yeah, so I think there's kind of, reporting and communication, kind of post-investment and pre-investment, but I think we're talking about the pre-investment side. So, what I like to see is that, you've managed to get operational. So you either have a warehouse vehicle or something else that you're investing out of. So, share with me investments that you made, maybe even share the investment memos so I can kind of see your thinking, because again, I know you're going to have multiple closes, and sometimes I may come in earlier, sometimes I may come in later, but if I can see how you're progressing, then I can get a much better feel for how you're going to do, because it's not just your investment thesis, but I want to see that you can actually kind of win deals and serve entrepreneurs. So the more you can share on that as you go through, the better, and that will probably get me more interested.
Mhm. And I'd like to add, if you look at surveys of what LPs are asking for, increasingly they want more frequent communication, they want more transparency. So I'd be hesitant to give a hard number here and say, like, this is the cadence that's correct, like quarterly isn't enough, do this newsletter. The recommendations aren't specific. It's more about speak in your own voice, craft your own voice, and have that be part of your brand. For me, what that's meant is creating more of a visual brand. And it's a way of acknowledging to my LPs, like, hey, I know you're super busy. And, I just handed you this 15-page financial statement, but I also gave you a cover letter that on one page and some TLDR bullet points and a couple of graphs. If you have just 30 seconds, I got you. So your communication style should be, I see you and I got you. Right. So don't be afraid. Don't be afraid to develop that unique and authentic voice. Right. Like if you go out, like if you go out across the finance industry in general, right, and you look at a lot of websites, they're going to say generic things about, we're in the business of trust. We listen to our clients. Let's be frank, they say shit that is so vanilla, it doesn't say anything. So every time you are communicating with LPs, think about your signal to noise ratio. Think about, I'm not going to be vanilla. I'm going to really say something that lands. I'm going to try to make it valuable so that every time I speak up, they go, oh, yeah, there's always something valuable.
That's really good, actually. I think something that a lot of people don't think about is you only get so many interactions with your LPs. And in that, you're effectively trying to build up a target score or like volume of utils of trust in connectivity. So one part, or what I would do if I were in any of you all's shoes, which I have been before, is I would make a graph of, hey, here are 15 ways I can build a util of trust. This one's worth this many points, this one's worth this many points, this one's worth this many. And then I would attack every LP. You might get like 5 utils of trust per like introduction or like positive reference. You might get 10 from an incredibly thorough data room. You might get, call it 5 from remembering everyone's favorite summer destination and then having a story that you can tell about it, how you relate. And I would say that like your goal is to, prior to meeting any LP or founder, to have built as many utils of trust as possible. And I think to Steph's point, people do that through newsletters. They do that through frequent LP communication. Some of my best folks who I've invested in, not only do they do more frequent LP updates, but they also give market commentary on a bi-weekly basis. They also shoot out a deal update. They also have a, hey, here's what my founders need. We've completed these 3 things, but if you all have any extras, that would be really, really great. And then separately, like in my own position, I have one LP partner right now that matters to me, but like I'm understanding their personal lives like very, very well. Like one of the Lauder kids works at an investment bank, and I'm like, hey, here's this generative AI solution that scrubs data rooms. Like understanding these little things and showing that you're in the weeds is huge. And I would actually just have a system of how many positive interactions have I created per person that I'm trying to target?
Absolutely incredible, everyone. I know we've reached the top of the hour and we could probably do another hour on here with the incredible panel. Everyone, thank you so much for this. This was just incredibly epic. And I've learned so much personally, and I've spoken with each of you individually, and I've learned so much just from having this panel with you. And I'm just so grateful to have you on here. Is there any final like parting word of advice for like GPs that are emerging right now, they're trying to start a fund? Any final like kind of like one sentence kind of piece of advice for everybody here on the panel?
Don't
Steve?
let people get you down. Gotta keep going.
Stephanie?
Go be fierce. You're on the R&D team of humanity. We all need you.
Tyler?
Continuously evolve. Everything that you learn, put into your system, and don't be afraid to change things. Like, you're inevitable. The fun is just a part of you.
Amazing. Thank you so much, everyone. This was epic. Really appreciate it. We're going to be sending the recording out for everybody here. Hopefully you enjoyed this, and then feel free to subscribe to these. We'll do them every single week. So come back next week. All right, everyone. Thank you. Bye. Amazing.
Thank you.